Monday we will have a review of what we have learned from chapters 1 through 6. And then the following Monday is your first little test. Okay? You notice the use of the word little? Okay. That's to just calm you down. Okay. So that's kind of our game plan for the next 2 weeks itself. Generally, just a couple of other comments. I was very happy to see that people did very well in their homework assignments. You know, we always have a few, which I'll try to get to. But for the most part, people did well. And later on, when everybody is in, we'll talk a little bit more about the threaded discussions. Okay, so so far we had an introduction. We learned a little bit about governmental funds. We learned a little bit about general fund, a little bit about special revenue fund, something about permanent funds, and we're going to learn about the last two funds within the governmental funds today. But first, before we get started, as I spoke to you last time, there's something very interesting when you, in governmental accounting and long-term capital assets. And what is that? Do you record capital assets, or do you show items as assets in the governmental fund balance sheet? No, you don't, because it's based on what? A short-term focus. The measurement focus does not allow for us showing long-term assets or long-term liabilities. So we'll talk a little bit about that. We'll talk a little bit about what the different classes of assets are. We'll say a few words about depreciation. And once again, I know it's early in the morning, but you need to be able to distinguish between accrual-based accounting and modified accrual basis. Two different things. And as I talk to you, both sides of your brain should think about that. Okay. So we'll take a look at the next category of fund, which is the capital projects fund, and then take a look at the financial statements and a couple of special topics. So first, what are general capital assets? We all know what capital assets are. They are what? They are long-lived. They are physical assets. They can be intangible assets too. But in this case, notice the use of the word general capital assets. Whenever you see the word general, it should trigger something in your mind, which is that they belong assets that are used in governmental activities. If there are assets which are used in business activities of a government, they're not called general capital assets. They're just plain capital assets. So there's something about the use of the word general. If it says general, that means governmental activities. If it just says capital assets, it's business type activities and fiduciary. Okay? And that's the first thing. And that's why we talk about making distinction between capital assets of governments as opposed to capital assets of business activities and fiduciary. Because each one of them records them separately. So we need to understand that. What are these capital assets? Well, land, you have buildings, you have improvements, really nothing much except for two items which I want you to pay some attention to. And these are something called construction work in progress. What might that be? What does it mean by construction work in progress? Yeah.
It's unfinished construction.
Okay, so you've started building, let's say you're building a facility, and while it's being constructed, you're capitalizing that portion, right? And how about infrastructure? What is that? That's also unique to governments, infrastructure. What could infrastructure be? These are long, very long-lived assets, roads, sidewalks, things which, seem to last forever, but, they have to be maintained. But obviously, the point here is that they have very, very long lives. So those are two interesting pieces that come to mind. How about land? What's so unique about land that you learned? Well, you don't depreciate land. Though what you'll find out in governments is there is one area where we depreciate land. And if you can tell me that, you don't have to take the exam. The question is, when is the one time when you depreciate land? You know what? Should I let him off the exam?
Yeah, you should.
Actually, that's a very... What's your name, by the way? Justin. Okay. So we have to put some extra stars. Okay. Actually, it's a landfill itself. What you do is you're close. In fact, you're almost right there. What it is that if you have a landfill and you're putting waste in it, basically you are using up its capacity, and therefore we don't call it depreciation as much as amortization of that landfill space, which we'll learn about. Now, the next thing which I want to talk to you about is how do governments build these very large facilities? What's the process? Do they have cash sitting in the bank that they go out and just say, okay, here's some cash, let's go build? What do they normally do? What do? They go out and borrow money, right? Or as they bond. So that's one thing that you have to remember is how do governments finance their capital assets? And that's, by the way, the next half of this class. Okay. So this is the, we'll talk more about this. This is how governments finance general capital assets. They finance them through bonds, grants from the federal government or state government, transfer from other funds, gifts, and special assessment bonds or taxes. For the most part, it's really the tax-supported bonds which finance construction. Okay. So if you were the CFO of a government organization, that's what your decision would be. How would you finance a project? And so let me give you an interesting example. You had an asset which had a useful life of 20 years. Would you finance it with a bond which was 30 years? I want you to think a little bit. If the asset would last only for 20 years, would you go out and finance it over a 30-year period? No. And unfortunately, that's what governments do. What do you want to do? You want to match the asset life with your financing. Why do they do that? Remember that interperiod equity concept? Basically, they're pushing the expense to future taxpayers for benefits that they are deriving now. That's an example of a violation of interperiod equity. So this is more about government finance more than accounting, but I want to just give you an example of how things actually operate out there. So next time when you hear somebody building and financing, ask them what the asset useful life is and what the financing terms are. And capital leases. And capital leases are interesting because they are increasingly used by governments, again, to in some very creative ways. And let me explain to you, and we'll get into this a little bit more. In order for governments to issue debt, they have to be constitutionally authorized to do so. They just can't go about borrowing money right and left. And what it is usually is a percentage of the total value of property in that municipality. So if you had $100 million worth of property and your debt limit was 1%, all that you could issue would be $1 million. Capital leases are interesting because they are outside that cap. So very creative CFOs use capital leases to finance They're capital assets because they're outside the cap, the $1 million restriction that I gave you. If they were to go out and just traditionally issue bonds, that will fall within that 1 million. Again, we'll take a look at this in a moment. So general capital assets are acquired from expenditures of the general fund, the special revenue funds, and the capital projects fund. And this is what we'll take a look at, is the capital projects itself. And we'll talk a little bit more about this in a moment. Now, so what are the various ways in which you can acquire capital assets? What can you do? Oops, sorry, just lost my. What are the various ways in which you can acquire assets through? Well, you can go purchase it, right? And when you purchase it, what do you record the asset at? Always. It's no different than business. It is at what? At historical cost, whatever you've paid for it, right? And to whatever expenses there are to put it to use, right? And then sometimes government get assets which are donated to them. If they're donated assets, they are valued at fair market value. So you got a collection of you've got a painting, or you've got some artwork. Well, you value that, and somebody donated that to you. You value that at fair market value, not at historical cost. So if you purchase it, it's at historical cost. If it's donated, it's at fair market value. So you purchased an asset for $1,000, $1 million, whatever it might be. It costs you $20,000 for transportation. It costs you $20,000 legal fees. What's your total cost of that asset? Is it just 1 million or 1 million plus those two items? Plus those two items. It has to be what it takes to put that asset to use. All right? Let me give you another example. You go out, somebody comes in and donates their collection of taxidermy birds to, to the government to display. So you get it appraised, and it's valued at $10,000. $10,000. Now you scratch your head and say, how am I going to record this transaction? Because remember, in the governmental funds, modified accrual basis, everything seems to revolve around cash, right? Any cash exchange here? Actually, there isn't, and you're not recording it in governmental balance sheet anyway, because it's a capital asset. But how about under the accrual basis? How would you record a transaction like that? Somebody gave you, yeah. Well, it would be at fair market value because it's donated, but the journal entry there is you have to debit an asset, right, for $10,000. What do you credit? You credit a revenue account, some kind of a revenue account, which is because there's no cash involved here, okay? And you'll see examples of that in the book. The other thing that you'll find is that in governments, everybody know, did you learn about capitalization, what value you must capitalize assets at? So for instance, if you went out and bought a PC for $500 in a government, just one PC, would you capitalize it? Well, you'll ask, what is the capitalization policy? What is the minimum value that I need to meet for the asset to be capitalized? And the government might have a capitalization policy of $10,000. If you buy assets of $10,000 or more, you capitalize them. If not, what do? You expense it, which raises an interesting question. If you buy one PC, it's not, but if you bought 10 PCs or 20 PCs, you capitalize them. Now, it doesn't mean that you don't tag the inventory. You still might tag for control purposes, but it's just that you don't record that in your books. So capitalization policies are something else to keep in mind. So once again, two things I want you to remember. One, in the general fund, you never record capital assets because it's what? Modified accrual basis. Because you don't record capital assets, you do not record depreciation. There is no depreciation expense under modified accrual basis. Under the full accrual basis, you record capital assets as well as you depreciate them. And the way you do this is when you depreciate something, you assign the depreciation to the different functions. If you had 5 functions and the municipal building was used for all those 5 functions, you allocate depreciation to each one of those. Okay. So the question is that under the modified accrual basis, if you went out and bought a piece of equipment for $1,000, how would you record that? Well, you know cash is leaving, 1,000, and lo and behold, and this is what will drive people crazy, instead of debiting an asset account, we now debit an account called capital expenditure. Okay, and this is what that slide is talking about. And this talks a bit about depreciations, things that you cannot depreciate. Okay. And we'll talk about infrastructure in a moment. Two things you don't depreciate: land, and remember that work of art or historical treasure or similar assets, certain non-capitalized works of art, historical treasure, or similar assets, which makes sense. Okay. And finally, infrastructure, which we'll talk about in one moment. Any questions so far, by the way? Now, there's always a question or two on this topic. This is one of the most interesting areas in government. Under GASB statement number 34, which is completely redid the financial reporting model for governments, what happened was that, tell me one thing, if you look around in a town, what do you think some of the largest investments of the government are in a town? Is it the municipal building, or are they roads and all the infrastructure that's in the town? Right? It's all the infrastructure and types of items like that. So infrastructure items are very important. There was a big discussion very early on where this financial reporting model was being discussed to forget about the infrastructure altogether because there's so much of it. But because of its material nature, they decided to include the infrastructure asset and to record them in the government-wide statements. Okay. You can depreciate everything, but with infrastructure assets, you have an option. And this is the option. The option is, and I'll give you an example. Think about infrastructure assets in a town worth $10 million. And let's say you said 40 years even. Well, that's $250,000 of depreciation every year. And some public entities were reluctant to record that kind of depreciation. I mean, that's crazy. $250,000 of depreciation for a little town. It will, everything else will become irrelevant because the depreciation expense will be so much. So what GASB did was it gave them an option. What it said was, you have an option. You can depreciate it, or you can maintain that infrastructure asset. If you maintain it properly, and I'll define what properly is, you don't have to depreciate it. So for instance, in that example which I just gave you, if it costs you $100,000 to maintain your infrastructure assets every year, that gets expensed, and you don't have to record depreciation at all. That's called the modified approach. Now, it's interesting because when you look around, especially now when you're driving on the roads, you see what? Lots of potholes. Last week I was in Nevada, and I said, where are the potholes? I was in northern Nevada, but I said, where are they? And you get to see the condition of our infrastructure compared to other parts of the country. It's really beaten up here. Okay? So GASB has said you don't have to depreciate it if you do the following. You have to have an asset management system. You have to keep an up-to-date inventory. You have to record the condition of your assets, and you have to maintain them. You have to record the condition in terms of a scale. It could be 1 to 5, 1 to 10, whatever you come up with, and you have to maintain it. If you do all of those and you maintain the infrastructure asset, you don't have to depreciate your infrastructure asset. Yeah?
So, under the modified approach, you would record it also in the general fund?
The expenditure would be recorded. Yeah. 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 It would be recorded. Okay. It's very, very, anybody else have any question, any observations? I know it's early, but this is, as I said, you need to understand this only applies to infrastructure assets only. And these are the conditions. If you don't meet these conditions, you have to start depreciating. So if you are the auditor for a government and you went out and you asked for these questions and you didn't, and the response came back, well, the roads are worse today than they were last year. Trouble. It means something is wrong. Okay? Yeah?
How do they determine if things are properly maintained?
Very good question, actually. And that's why what you need to do is, it's usually engineering reports on the condition. So you have an engineer who prepares and assigns a scale of its condition. And that engineer is rehired every 3 to 5 years to do a reassessment. And that's how that's done. It's not, accountants don't do it. It's usually an engineer who comes in and does that. Yeah.
So if the engineer comes in and says that they haven't maintained it,
Yes.
by not depreciating it, you have to depreciate
Yes, you have to go back and start Yep.
Yep.
Yep. You have to start depreciating the asset itself. Now, some people like to depreciate assets. And it's interesting because some do, especially those which run a lot of business type of activities, because they want to show the use of the asset. So they do. Some people do that. Okay. And so it's all about documentation. I mentioned this to you because, if you ever, some of you will become auditors, hopefully, and some of you will have government clients. And when you go out, this is what you'll be faced with. This is exactly what you will see in your assignments. And this will be a question if you're running an audit. This is a question which comes up every year. You'll ask the official and they'll say, oh, they're just fine. Everything's fine. We had, things were really bad. We're going to fix it this year. But you have to start thinking now, what do you do now? Okay, let's take a look at some journal entries now very quickly. Everybody understand this? This is under the modified accrual basis in the general fund. Notice we debit expenditures, not a capital asset, right? Because it's under the general fund. But what happens under the full accrual basis or governmental activities? Same transaction now is recorded with a debit to equipment. Let's take a look at capital leases. Anyone remember the criteria for how you determine whether it's a capital or operating lease? Did you learn this yet? Okay. Are you doing it now, or did you?
Yes.
Okay. All right. So the criteria, as you can, so all leases can be defined in what? Capital or operating, right? If it's an operating lease, it's what? Expensed, right? If it's capital, it's treated almost as if you acquired the asset. And what are some of the conditions? Lease transfers ownership at the end of the term, right? You have that. What other things? Bargain purchase price. Exactly the same for government. Anything else? 75%. Boy, you guys know it. Okay. 75% of it has to be greater than 75% of the useful life. Anything else? Boy. Okay, you got it. That's exactly it. Minus the investment tax credit, right? So that's very good. And governments do exactly the same. They use the same criteria for defining whether it's a capital or operating lease. But what I want you to do is remember this transaction which we just looked at. Remember this transaction. Now we go and take a look at a transaction which uses a lease instead of paying cash. And notice this account called Other Financing Source Capital Lease Agreements. So what is happening is it's a capital lease, but there's no cash involved, but we recognize this as a other financing source capital lease agreement. This could be special revenue, general fund, doesn't really matter. The point here is just because it's a capital lease and doesn't involve cash doesn't mean you don't record it. You still record the lease as an expenditure. It's hard to figure this out, but you have to remember this, that a capital lease is recorded as other financing source because there's no cash involved. Yes?
Why is it under special revenue fund?
Oh, it could be general fund. It could be really. It's just, that was just an illustration for special revenue fund. It could have been a general fund too. Yeah. But notice the difference here between the two. In the second case is what we learned, right? In accrual-based accounting, which is always what? Some kind of a payable account, right? But in the first, it's a type of a revenue account. So you should understand or remember this. Okay, let's take a look at okay, actually, we're going to take a look at a question in the text which deals with capital leases. Okay. This is a question on page 205, if you have your book. Question 5.5. And just read this for a moment. Okay, who's got a good calculator here? Okay. Don't get lost with the numbers as much as the transaction. Try to understand what's going on here. So these folks went out . Can't hear me. See it? Okay. So these folks go out and sign a lease. So it involves what? 30 payments, right? Okay. Now, first of all, using the criteria presented in this chapter, determine whether this is a capital lease or not. Well, what does it sound like? Yeah, it sounds like it is a capital lease. I mean, you've got all the, when you look at it, it has all the markings of a capital lease here. But more importantly, remember somebody said that it had to be 90%, right? What was it? For a capital lease, right? So how would you determine that? So how many payments? $847,000 each year, right? For how many years? 29 years, right? And with an initial payment of $849. So if you had to do the value of this lease, it would be 95%. Can you tell me how you did that? Number sounds good. Yes. No, actually you're absolutely right. It's 95%.
Minimum lease payment for 29 periods, not 39. 6%.
Good. So, all right, let me just write this down so you can just kind of see how this is done. So you have 847,637, right? For no, let's just make it simpler. They already have given us the present value factor. So 847,637 times 13.590721, right? That's 29 periods. Plus initial payment of what? 847,637. And that gives you the total value of the lease payments itself, right? Or the total net present value of the lease itself, right? And it's probably 12 million and something there. 12.5 million divided by 13 million gives you 95% or so. Everybody see that? That's the hardest part of the question. But let's go to the next one. This is the accounting part of the question. How do you record the transaction itself? Think about the transaction. Let's talk about the general fund. How did you record the capital lease in the general fund? Debit expenditure and credit what? Other financing source, right? It's the same entry every single time. Okay. So it's debit expenditure and credit what? Other financing source, plus there's also cash payment, right? There is a cash payment too of 847. Okay. Let me just look up the exact number here so I can give you the number. Okay, here, okay. So this is the journal entry. By the way, the total value of the lease after the number calculating is 12,367,635. 12,367,635 is the total value. 635, okay. And basically, the entry in the general fund or capital projects fund or special revenue fund, doesn't really matter, is debit expenditure of 12,367,635 and credit cash, because we're making the first cash payment of 847,637, and other financing source credit 11,519,998. That's the journal entry. Again, the numbers aren't as important as understanding the journal entry. Debit expenditure, credit what? Other financing source. And if there's cash, credit the cash. Now, what would you do in the full accrual basis under governmental activities? The debit equipment and credit what? lease obligation payable for the full value, whatever that is. Got it? Those two entries are always, there's never a change to that. The numbers can be different, but the entries are always exactly the same. Did you need help with that? Are you all set? Huh? Okay. Yes.
If we wanted to use our financial calculators, do we assume that the payments are made at the beginning of the year?
Hold on 1 second.
If we want to use our financial calculator, do
Yes.
we assume that the payments are made at the beginning of the year?
It will, if it says that it's made at the beginning of the year, then obviously.
Okay.
Yes, it's always with leases, capital leases, it's usually a payment first, made at the beginning of the period. Any other questions? Yeah.
What was the second journal entry?
That second journal entry was just debit equipment and credit lease obligations payable. Yeah.
That's under accrual.
That's under accrual basis. Okay. So again, just to recap, understand how to record purchase of a capital asset using cash, which I showed you the first time, and under capital lease. Okay? And again, that's the journal entry. Okay. Now, capital asset disclosure. What you'll find is that there's quite a bit of disclosure on capital assets. And actually, we can take a look at a sample. Okay. What I want you to do is, this is from the Comprehensive Annual Financial Report, the capital asset disclosure. Notice how it's set up. Beginning balance, addition, retirements or disposition, and the ending balance. See how it's laid out? Okay. Next, look at how it's divided. Governmental activities and business type activities. Everybody got that? Okay. Governmental activities and business type activities. Capital disclosure. Next, capital assets that are not being depreciated are separated from capital assets which are being depreciated, right? Got that one? Next, accumulated depreciation is shown separately, right? A little different disclosure than what we are used to. All right? And again, it's the same story on this side. But the important thing is that this part is separated from this part, and you separate items which are being depreciated from items which are not being depreciated here. So what are the items not being depreciated? Land, easement, art, construction work in progress, software development. Notice capital asset being depreciated. Are these guys using modified approach? Is this entity using modified approach for its capital assets if I showed you this? No, because they are doing what? They are depreciating. Everybody with me? Okay. Everybody got that? Okay. All right, so you looked at this. Let's go to the next one. So there is depreciation expense. Notice how it's being allocated to these functions, the business type activities and governmental activities. This is in the government-wide statement, which is the government-wide statement of activities. So depreciation is usually allocated to the assets, to the functions themselves. All right, since you guys are so good at this, let's try to do another question. I want you to take a look at this and tell me what's wrong. Page 205. Just take a few minutes. Okay. So who wants to volunteer for this? Yes. What's wrong with this picture? Very good. Yeah. Doesn't separate that. What else? Does not differentiate between acquisition and disposals. It shows it as one column. Very good. What else? How about throwing everything into one category? Remember in the other one disclosure we had land, we had all these, we had separate line disclosures for the different asset classes, right? For land, building, equipment, right? Okay. Anything else? Yeah. Yeah, that's what we were talking about. Have to, you know, the only other thing is it doesn't show the last part of the schedule, which is the depreciation expense by function, because that's part which we just saw. So those are the items. When you look at it, those are the things that are wrong. Now, tell me one thing. Does the county use the modified approach to account for infrastructure assets? Do they use the modified approach or they don't? Yes, they do. Because it said capital assets not being depreciated, infrastructure is shown as part of that. Is everybody with me? Okay. I see it. Maybe it's early in the morning, but I need some more energy from you guys. Okay? Yes, it is. And then, by the way, the last question, which we won't get into, is what percentage of the useful life of the depreciable assets remain? And this is just a matter of, calculating this number, which is, it's 15 million on the right. Depreciable assets are what? 15,068,000. And total depreciation is what? 4,002,000. So whatever is left, 15 million, let's say, is left. 10 million is left. 10 million divided by 15 is 70 some odd %. That's how you do that. Is it a tough calculation? What's the total total assets which are being depreciated? 15 million. What's the depreciation? 4 million. What's left? 11 million. 11 divided by 15 is whatever, 75%, whatever that number is. Okay, so that's an example of how we do this. 73%? That sounds good. Excellent. Okay. All right. Any questions on that, by the way? Everybody still? Okay. Here? Okay. And this just really talks about what happens once you acquire those assets and you have additions and betterments. And I think most of you know, if it extends the life of the asset, what do? You capitalize it. If it's a maintenance item, what do? You expense it. Yep. And that's what this talks about. accounting for disposition. What happens when you sell a general capital asset? You have to remove the asset, and this is what happens. You sell a machine for $500. It was originally purchased for $8,000. Notice how it shows up in the general fund. Any reference to $8,000? No. This is like our cash basis. All you're concerned about is what? The cash that you're receiving. And this is the problem with, people don't understand this. Why is it this way? Because it's modified accrual basis. But look at what happens in the governmental activities. You got to get rid of the equipment by crediting it. You have to get rid of the depreciation, and you show gain on sale of equipment. Anyone not understand this transaction? This is what we know of. We don't know the top one, but this is what no different than what you would do if you were to record this at the, for a commercial enterprise. Whenever you sell an asset, what do you have to do? Get rid of it and get rid of the depreciation. And that's what you're doing. Accumulated depreciation is a credit balance, so how do you get rid of it? By debiting it. Asset has a debit balance. How do you get rid of it? By crediting it. You receive cash, and the rest is a plug-in number, which is your gain on sale of equipment. Notice the next example. In this case, the building was demolished. The cost was $5,000. This is how you'd record that transaction. No different than the other one. The top one being modified accrual basis. Asset impairment. Interesting area in governments. And basically, I'll give you an example. A government facility is out there, and all of a sudden a storm comes and hits that facility, and it's half destroyed. Well, what is it? An asset impairment. You don't have the continued use of that facility like you did before. And there are various types of impairments that can occur. So look at the word. Is a significant unexpected decline. Not expected, but unexpected decline in the service utility of a capital asset. It could be physical damage, it could be obsolescence, it could be other environmental factors, okay? And impairments are considered permanent. Why are we concerned about it? Because we need to record this transaction. And this is what we're going to learn. Remember, every time we talk about recording a transaction, there should be two light bulbs which should go into in your brain. Modified accrual and accrual. Anytime I tell you record a transaction, those are the two light bulbs that have to go on. Modified accrual basis, accrual basis. Modified is easy because you think about cash. Does this involve cash? If it does, it's going to be recorded. Of course, lease is an exception, but that's what. Yeah, you had a question?
Yeah. What does it look like for an asset impairment?
I'm sorry?
What does an asset impairment look like for the journal?
We'll look at that, okay? If not, we'll take a look at an example. And how do you measure impairment? Because apparently you can't record a transaction unless you can measure it. And impairment's kind of a strange thing because there is no exact value being exchanged here. One is restore it. Whatever the cost to restore the item, that's the amount of impairment. Service units approach. Use of impairment due to environmental factors. Now the next one is kind of a very wordy thing, deflated depreciation replacement cost approach. More simply, impairment due to a change in the manner or duration of use. So, if you expected to use a facility for a certain period of time and now you cannot use it, that's where that would be. But better still, let's take a look at an example. on page 198, I want you to take a look at this question, 5.9. Just read this question for a moment. Okay, so everybody understand the facts here? So what happened? They had an office building and it became what? A storage space. Do both of those buildings have the same value? Storage space as opposed to office space? Okay. So basically, there is a decline in service utility. Now the question is, which one do you pick of the three methods? Which one do you pick? Which one is it? The last one? Absolutely. You pick the last one because it's due to change in the manner, which is what? From office to storage. So it's really not that. It's not difficult, but you need to just think through the facts. Okay? Now let's talk about how we go about recording the transaction itself. Actually, you know what? I think I assigned you a question on this, on asset impairment. This exact same thing here. I believe 5.6, asset impairment. Did I give you 5.6? Yep, that's the question. Yep. Report an asset impairment as a reduction of the carrying value. Okay, so again, remember what I said? Anytime I talk about recording transaction, 2 light bulbs. Let's start with the easy one here, which is the modified accrual basis. Anything happen there? Anything, any cash involved? Any commitment in the future? Nothing. 0. Let's go on to the accrual basis. Accrual basis recognizes everything, right? As we noticed. What happens there? You have to take the difference between you measure the impairment, book that as an expense. How do you book an expense? By debiting it. And what account would you credit? The asset account, because you're writing that down. The only important, the piece that you need to remember is if you show that as an expense, do you show it as an extraordinary item or a special item? You have to look at the definition on the statement itself. And the other thing is, if you get insurance money, just make sure either net it out of the program expense, but the better way to do it is to show it as program revenues. So you don't net the transaction, you show both the insurance as well as the cost. Okay, so under the accrual basis, you have to do what? Bring down the value of the asset, right? To bring down the value of the asset, what must you do? You must credit that asset. You need a debit somewhere. You would debit a program expense. Okay. And when you get insurance money, you debit cash and credit program revenues, right? And that's the question, by the way, that I just assigned you there.
Debit program expense, credit program revenue.
Yes, yes. Okay. So far, what have we talked about what general capital assets are, how we record them, what we have as the disclosure. We looked at capital leases. We looked at asset impairment. Now we go to the next major topic, which is capital projects fund, which is one type of governmental fund, okay, capital projects fund. And this is, don't make it any more difficult than it is. It's one of the simplest things that you'll find throughout the semester, okay? Did I say that before? I guess, okay. Basically what happens is when governments go out and borrow money, let's say you go borrow $10 million to build a building. The people who lend you the money want to make sure that you use it for the purpose that you borrowed the money for. So what they ask you to do is, and governments like to do this too, is they set up a little fund for construction of that building. A self-contained fund has its own assets, its own liabilities on a modified accrual basis. So the building starts off, so what's the first thing that happens? They go out, borrow money, $10 million, right? $10 million is transferred into the capital projects fund to get the project started. They sign the contract with the builder, with the architect, with all these folks. Encumbrance accounting is now used. A budget is used because this is what? A governmental fund. So you now do that. Once and while the building is being built, you record all the expenditures as construction work in progress. So you can, it's like a little bucket which is holding these costs as you go along. Once the building is completed, capital projects fund is closed. And the asset is what? Transferred under the full accrual basis to the government-wide statement of net position. And that's what we'll see right now. Very simple cycle of transactions, but two types of capital projects: general, those which benefit everyone, and these benefit only a few. What's the difference? This is paid by all the taxpayers, and this is paid by what? Those who benefit from that improvement. That's why it's called what? Special assessment. I want you to take a look at this because the first thing I want you to remember is that even though the words used are capital projects fund, if I ever ask you, do you show capital assets in capital projects fund, what would your answer be? No. You only show them as being built, but never when they're completed. Once the asset is completed, the account is closed and you transfer the asset out. Okay? So they are long-lived assets, meaning not little things, but big things here. Usually involve a construction project. They have long-range planning, financing, project life focus rather than year to year. So a project can be done over several years, and it has that focus of that. Okay, and these are some of the things that you should take a look at. With long-term financing, usually you have to go out and get, through a referendum, the ability to raise money because it's the taxpayers who are going to pay for it. Okay. These are the general entries, and we'll just go through this cycle quickly here because there are lots of them here, but I want you to just see what happens. So they have started a office building project. And one of the reasons they started doing this was they're going to get some money from the federal government. You know, sometimes federal government, state government might give you money and say, look, you borrow $9 million, we'll give you $1 million. Well, this money came in from the federal government. It's coming in. They've got a commitment, so they recognize this as a receivable and as a revenue. Money coming into the capital projects fund. This entry is not very different, just the item is called differently. Program revenues under the full accrual basis. Okay. They're getting a loan from the general fund for $50,000 instead of just a cash infusion. If it were just from general fund without any obligation to pay, it would just show up as other financing source. And then you ask me, but wait a minute, we always thought that we didn't record liabilities. But you know what? This is interim financing and short-term loan. So if it's a short-term loan within a year, which has to be repaid, you can record that. And this is the problem that people have with some of this stuff. They say, on the one hand, you tell me you cannot record it, then you tell me record it as a payable. Well, because it's short-term interim financing. Short-term stuff you can record, not long-term. Anyone tell me no entry needed? Why? Why no entry needed? Didn't we just borrow money? Okay, let me ask you a question. Capital Projects Fund, what is it a part of? Governmental funds, right? The government-wide statement has governmental activities and business type activities. Does it differentiate between the different funds within the governmental funds? No. It's like this. You have a family of 5. You prepare a balance sheet, a family balance sheet for publication outside. Any amounts that are due and paying within the family members, do you care? No. If you prepared it internally for each person, you would care. But if it's for the entire family, it isn't. And that's what with governmental funds, that's why we don't record them, because what we have here is within the funds themselves, within the governmental funds. If it were from, would you have to record it if it was from the business activity to the governmental funds? Yes, because that's what? It's outside the governmental funds. Here's a contract that's signed. Usually what's one of the first steps that is taken with when you purchase items or when you commit items to items in the governmental? You set up what? Encumbrance. We talked about that last time. Always you set up an encumbrance, but under the full accrual basis, we don't recognize encumbrances at all. Again, this is from the last time. They go ahead and pay the bill. The encumbrance was for $50,000. It only cost $48,000. You reverse the encumbrance, these two entries, and you show the actual expenditure here. Construction work in progress is shown here under the full accrual basis. And let me just, I'm going through this quickly. I'll try to explain to you the pieces that are really important. Okay. Remember I told you that when you issue bonds, you issue them at face value. Hopefully you raise $5 million, you borrow $5 million. What you get back is dependent on what rate you're going to pay on those bonds. They can be sold at a premium or at a discount. In this case, what happened? The bonds were sold at a premium. So all they needed was $5 million. What did they get? $5,050,000. But notice what happens. The smart accountant said, just because you got $5,050,000 doesn't mean that it's yours. $650 of that should go to the debt service fund to pay off the loan. Okay? And that's what you see here. And here it's premium on bonds payable because that's how we recognize that transaction. And again, you get the money from the federal government, so you reverse the entry that you had made previously. Interfund loans payable, you pay the general fund back, so there's that entry being reversed. Again, contract was signed. Anytime you sign a contract, what do? The first thing, you create an encumbrance. And the entry is always the same, debit encumbrance and credit encumbrance outstanding. No activity, nothing in the governmental activities area. Everybody with me, stop me. I see some glazed eyes. You need some coffee. We'll take a break shortly. Okay. You know, I don't know if you heard, but they did a study. I'm sure everyone's heard this. High school students, that it would be best if the classes started later. You've all heard that, right? And I guess it's just not high school students, it's also us. And for me, I'm really suffering because I'm 3 hours back, you know. So, you know, it's more like when I got up more like 3 o'clock in the morning. Okay. So I have to keep on going. So if I fall over, you know, pick me up. Okay. So here's the construction expenditures. You recognize it. Again, the way to remember this is the basics. With governmental expenditures, usually there's an encumbrance. When you pay the item, you reverse the encumbrance, and then you record the transaction. Notice, instead of construction expenditures, you have construction work in progress, because there is no expenditures in the full accrual basis. This is what? An asset account, construction work in progress. This is not an asset account. This is expenditures. Okay, now another thing. Let me just explain this to you. Governments don't trust contractors to do things right. So what they do is they withhold a portion of the payment. So in this case, it's 5%. Contractor presents an invoice for $100,000. What do they pay them? $95,000. Contractor says, not fair. They say, look, when you complete the project, and if we are satisfied with it, we'll give you that $5,000. What's that account called? Contracts payable retainage percentage. If it has a credit balance, what kind of an account is it? A liability account. Because you're going to eventually pay it. It's just that you're holding. Why do governments do this? If they find a problem, they rather not go sue. They rather use that money to fix things and then give them. It happens all the time with large-scale contracts. What was one of the largest construction projects recently undertaken? Yes? How about in this part of the country, Northeast? Big project, one of the biggest projects. That's it. What was it? The Boston dig, the big dig. What was it estimated at? 6 or 9 billion, went up to $14 billion. Okay, one of the largest construction projects, which, you know, is an example here. Okay, but this is, can you imagine people arguing about this there, right? So this is a retainage percentage, and eventually they'll repay that 150, which we have. Again, they recognize the item as it's being spent. Next payment comes due. They withhold again 5%, 100,000. So now what is it? 150 plus 100, 250 they owe this fella. Okay? It had to be more than 250 because they withheld 75,000. And notice this, the cash was paid and now the contract can be closed out. This is the final entry to close all accounts. So let's try to read this. When you close accounts, what kind of entry do you make to the account? Exactly the opposite. If you close a revenue account, what would you do to it? You would debit it. If you close an expenditure account which has a debit balance, what would you do to it? Credit it. And this is what we're doing. Other financing source, $5 million, which was shown originally as a credit, we debit that. Revenues, which were originally shown as a credit, is now shown as a debit. Construction expenditures, $5 million and 48. Governments always like to see budgets. What's the word? On time and under budget. Those are the two magical words. If you hear that, you're happy. On time and under budget. Well, it looks like they did okay because they had what? $52,000, which remains. What are they going to do with this? Because the project is done. They transfer it out. It could go to the debt service fund. It could go to the general fund. Okay. Here it's being transferred out, looks like to the debt service fund. Why? Because this is the fund that's going to pay for all the principal and interest. Notice what happens once the construction project is completed. Construction work in progress is now eliminated, close to a building account, a real asset account. Notice that construction work in progress had a debit balance, so we credited it and we debit the building account itself. So let me just go through this quickly. What's capital projects fund used for? Construction of what kind of projects? Do they use budgeting? Do they use encumbrance accounting? Okay. And where do they get their money from? Bonds. When they get that money, what's usually, what do you debit and what do you credit? You debit cash and what do you credit? Other financing source. When you sign the contract with the contractor, what do you debit and credit? Debit encumbrance and credit encumbrance. Good. Encumbrance outstanding. When you pay the contractor, what do? You reverse that entry for the amount. And what else do you do? Credit cash and debit construction expenditures. Do you give the guy the full amount? You hold it as retainage. And how does that show up? As a credit, right? When the account is eventually closed, what do? You pay off the retainage, right? And you do the closing entries. And once the project is closed, what happens to the account? The building, from construction work in progress, it becomes the asset account itself. Don't make it complicated. That's really all that it is. I know I sometimes I say things that's easy, but and these are things that we talked about. Okay. We have a few more slides and then we'll quickly go through the homework and take a break. Okay. So these are the things that are important. There are financial statements which show up in the book itself. Let's see. Actually not. I thought there was something here. Okay. So everybody see this? Buildings included, long-term liabilities reported in the government-wide statement. and depreciation expense is allocated to the different functions. Everybody know about major and non-major funds, right? If the capital projects fund is a major fund, you show it as a separate column. If it's not, where does it go? Other, other non-major, right? Category. And when it goes there, where do you have to show it? In the combining statements. What are the combining statements? If something is not major, it shows up in the combining statements, which is like a supplementary schedule with all the information. Okay. By the way, there is one thing which I think I forgot to mention to you, and there isn't. Did I talk about interest incurred during construction? What do you do with interest that's incurred during construction? Do you capitalize it or not capitalize it? No, you don't capitalize, and that's one of the things you have to keep in mind. So if you are incurring interest during construction, don't capitalize the interest. Okay, a couple of other things. I won't talk about this accrued interest. Everybody know what accrued interest is? By the way, do you take a course in finance in this class, in this program? So you've learned how to calculate accrued interest. And, okay. So, oh, here's the slide. Oops, sorry. I thought it wasn't, but here. Interest costs incurred during construction are not capitalized. Always shown as an expense or as an expenditure. Very different from what we're used to. So just remember that. Yeah?
This is only for government projects, so
Yeah.
private?
No, just for government. This is just for governmental projects which are run through Capital Projects Fund. Do you understand that? Yeah. Only for those. If it were business type of activities where they're doing it on full accrual basis, they would recognize it. But only for governmental funds.
So would you consider something like MTA projects, even though it's like?
An MTA project, if it's classified as a business type activity, then they would. But in the case of MTA, it is actually classified as a business type activity, so it would be capitalized.
Even though government funds are subsidized?
Yes, but it's run as a business.
Okay.
Yeah.
So in terms of free to tab, one would be a business type, even though the tab.
Yes. And we're going to talk about this in the next chapter, in chapter 7, about those type of activities and how do you classify whether it's a business type or a governmental activity. Okay? Basically, it should be the intent of the government to run it as a business type activity. If it is, then it can be classified as business type activity. Yeah. Okay, a couple of other things, arbitrage rebate, and all I can tell you about this is, and this really belongs more in the next topic rather than here, but if you are the CFO of a governmental entity, you could have a perpetual money-making machine. How do you do that? You borrow money at tax-exempt rate, and what do? Invest it at higher rates. And you've got a money-churning machine. Just keep on borrowing. You borrow money at 1%, invest it at 2 or 3%, and you can do this forever. Does the federal government like that? No. And that's called arbitrage rebate. The difference between what you're borrowing and what you're investing. And read this slide, which is what it does is that the federal government has this rule that if you make money beyond what the regs say, for instance, things like if you spend, you need to spend all the proceeds on the tax-exempt bond within a certain period of time. If you do that, and even if you make money, you don't have to worry about it, like within 6 months or so, okay? Or if it's 85% of the bond proceeds are spent within 3 years, you don't have to worry about it. But if you don't need those, any extra money that you make has to go back to the federal government. So, and you're, as an auditor, you will be auditing those calculations, the arbitrage. And I won't go into the calculation, but it's not really rocket science, because all it is comparing what your return was as opposed to what your cost of debt was. You want it to be very equal. And what they have is, I don't know if these Treasury still does that. I know we used to do this. They're called slugs, state and local investments, where basically what you do is you invest your bond proceeds with a special fund run by the U.S. Treasury, which gives you minuscule amount. So you don't run afoul of the arbitrage rebate regulations. You can have projects. If you have 3 building projects, could you have 3 capital projects? Yes. Could you have capital projects which run over several years? Yes. This is what it talks about. And special assessment, as I said, one is paid by general taxpayers, and the other is paid by those who benefit. And basically, and we'll, again, I'll hold off on this because we'll talk about this more in Chapter 8. So that is Chapter 5. And we tried to hit on all the important pieces. Let's do one thing now. Let's take a quick look at our, actually, let's take a quick look at our homework. Take a break and then here. Okay, so now the last of the governmental funds, which is the debt service fund and the general long-term liabilities. Notice the use of the word general. Just like general capital assets, what is this? General long-term liabilities. So are general long-term liabilities the same as long-term liabilities of the enterprise fund or the fiduciary funds? No. The word general gives it away. It's associated with the governmental. So this is what we'll take a look at, just basically what they are, what the journal entries are, what the disclosure is, just like we did with the other. We'll talk about debt margin, overlapping debt. Debt margin basically tells you how much they can borrow. Debt limit is what the maximum they can borrow, the different types and purposes of debt service funds. And there are a lot of journal entries. We'll skim through some of them quickly. But let's first talk about what are general long-term liabilities. Interestingly, the way that is defined, it's not a liability of the proprietary or fiduciary fund. What are examples of proprietary fund? Enterprise fund, internal service fund, right? Okay. If debt is reported in the proprietary or fiduciary fund with the full faith and credit backing the contingent liability should be disclosed in the notes. Let's take that example before someone asked about the MTA. If MTA issues debt and the debt has, in the bond covenant it says if MTA is unable to pay, City of New York will pay. That's a contingent liability and has to be disclosed, and that's what it means here. And why do entities do that? To be able to sell bonds. Maybe there might be folks who might not want to purchase bonds if they're backed only by a proprietary fund and not with the full faith and credit. Here, as you see, it's full faith and credit.
So if the MTA has debt, unable to pay it still?
Well, if it is done with, if it has debt which is repaid from the fares, but the debt is general obligation with full faith and credit of the City of New York, then they have to disclose it in their financial statements, even though the debt will be shown in MTA's books. But they have to show that as contingent liability. Do you see what I mean? These are the types of general long-term liabilities. So lo and behold, we thought long-term liabilities were only debt. But look at some of the other examples. Bonds, warrants, notes, capital leases, unfunded compensated absences, vacation and sick leave, unfunded pension obligations. Remember when I showed you the balance sheet, the statement of net position for the state of New Jersey? This was a huge number, billions and billions of dollars. Long-term portion of judgments and claims. So anytime you read in the Star Ledger about a trooper getting sued and the state having to pay, well, that is a judgment and claim against the state. Pollution remediation obligations themselves. So we'll talk about this shortly. These items, compensated absence and pension obligations, especially pension obligations, are very big in governments. And as I said to you, this is what's going to sink a few cities and few states. Because what happens is, and not to go too much into this, but you know, there are two types of pension plans. There's the one which everybody wants, which is a defined benefit plan. You get paid a certain amount of your salary when you retire, regardless how your investments do. The state would manage them. And then there is a defined contribution plan, okay? And in one case, basically, you get benefits which are defined, and defined contribution is whatever you put into your fund, and when you're 65 or 67, whatever is left, you can draw that down. So who carries the investment risk? You. So that's why people like defined benefit plans, because it doesn't matter what the market does. You will get what's promised to you. But that promise is based on you're putting some money and your employer putting some money. Well, in the for-profit arena, in the business entities, it's very straightforward. You put 5 or 10% and the employer matches it with 5 or 10%. With state government, you put in 5 or 10% and the employer, in this case the state government, is supposed to do this. Well, in many cases, this hasn't happened. The employee has made the contribution, not the state. And what has happened is continued funding of this, underfunding of this has led to some serious, serious problems. So GASB requires that if you have unfunded pension, you disclose the unfunded portion of that liability. And we'll talk more about this in Chapter 8. Actually, we'll spend quite a bit of time on this. But lots of real serious problems, you know. And pension funds are interesting because they're based on this asset liability model where you put a certain amount in and hopefully at the end you'll have enough money to retire based on your age expectancy. But if your rate of return on the market was 5 or 6%, let's just assume, and you assume as your rate of return 10%, is that a good idea? No. Because you're never going to meet that rate of return. And that's what the states have done. Many, many states have overestimated the return they'll get. Why? So they wouldn't have to put extra money into the fund. But now cities like Detroit and others Illinois. These guys have, I don't know how they'll pull out of the problems that they have.
The other thing too is that they have hedge fund managers managing these pension funds.
Yeah.
And you and I both know
Yeah.
that there's really no profit. They take all the
No,
all the fees.
well, with the hedge funds, you have
hedge
to,
funds are real risky.
and it really has to do with, and there's could be a half a course taught on just pension fund investing, because it's not like other types of investing, as you said. Hedge funds, managers, these guys haven't done well in the past 5 years. Their performance has been really awful. And you could do better by investing in Vanguard's, what's that fund, the one that invests in 500 different stocks, the biggest one. You'll do better investing in those than investing with a hedge fund manager, which is hard to believe. But so these are the types of general long-term liabilities that a government has. One area that I want to just talk about, which is kind of very different from anything else you'll see, is this thing called pollution remediation obligation. About 5 miles from here, not even 5 miles from here, there's a town called Kearney. And Kearney has these landfills, big landfills, like mountains of trash. And what happens is, every time it rains, the water goes into the landfill and comes and pollutes the streams and other areas around it. Not only here, but around the country. But New Jersey has the distinction of having many Superfund sites. These are the sites designated by the EPA as being the most hazardous. In fact, if you ever want to buy a home, before you buy a home, get onto the EPA site and DEP and look at a list of all the hazardous fund sites closest to your home, because you might be surprised that little vacant property a block down from where you are might be classified as a hazardous site. You don't want to be buying in that area. Okay? So, so what happens now? Somebody's got to come up with money to clean this up. So what happens eventually is everybody points at each other. They tell, oh, this was the company that dumped here. Let's go after them. Oh, they've gone bankrupt. They've disappeared. Now what do you do? Okay, so let's find somebody else. Well, you can't find somebody else. Who's stuck with the cleanup? The town. And that liability has to be shown in your statement of net position. And that's the pollution remediation obligation that you have as a general long-term liability. And this slide really doesn't do justice, because there are criteria for when you should recognize it, because there will be big arguments between the auditors and the town as to whether you should show it or not. And basically, is it a danger to public health and welfare? Yes. Is the government in any way obligated to do the cleanup? If they are, yes. Has the government accepted the responsibility to clean it up, except they haven't done it? If yes, absolutely yes. Okay. So, and then there is a legal term, it's called potentially responsible party. If the government in any way was involved with dumping stuff there itself, it becomes then a potentially responsible party. So basically what this says is that if you have all of those, you hire an engineer goes out to the site and says it's going to cost you $5 million to clean the site. You know that $5 million has to show up on your balance sheet as a liability. What happens when you show things as liability and you don't have cash? Your equity goes the other way, which we call what? Net position. What happens? If your liability increases and your assets remain the same, what has to happen to the net position? It goes down, because your liabilities now are taking its place. So that's what this is. And the liability is measured using expected cash flow. But again, not to get too much into it, but it's kind of interesting. Again, these are some basic principles. They're always reported on the government-wide statement of net position, not in the general fund balance sheet. And then we'll talk about debt service in a moment. Now some calculations. Let me give you an example. In New Jersey and many states, towns don't have the liberty to go out and borrow anything that they want. Why? If you were to go out, if you were the homeowner in that town, and your town went out and borrowed money like crazy to do all these things, who's going to end up paying for that? You, as the taxpayer. So what has happened is in many states, they limit the town on what they can borrow. It could be 1%, it could be 5%, whatever that number is. But 1% of what? 1% of the total value of property in that town. So if you had $100 million worth of property and it was 1%, you could only borrow $1 million. You borrowed $500,000. That's what, by the way, that $1 million is called debt limit. What's your limit? $1 million. You borrowed $500,000. What's left? Another $500,000. That's your debt margin, what you have left, right? These are the terms that we are going to be talking about. Overlapping debt. Overlapping debt is interesting because, you know, in New Jersey we have towns, we have counties, and then we have state. When the county of Essex or county of Morris goes out and borrows money, who pays for that? The taxpayers in each of the towns which are within the county. So not only do you have to worry about your town, you have to worry about what? Also your county. That county level is called the overlapping debt. That is obligations of other governments that also have the power to tax property located in the jurisdiction. But you say, wait a minute, the county doesn't tax my property, it's the town. No. If you look at your property tax bill, it's like 3 pieces of a pie. One piece of the pie is for the town, the other piece is for the schools, and the third piece is for the county. And you'll be surprised, the amount for the town is very small. Most of it is taken up by county and schools. And I shouldn't say county because some counties are less, but some counties are very high tax rates. And that's what this concept of overlapping debt is. So these are the definitions. Well, I just talked to you about the overlapping debt. It can be assessed, the 3 different pieces. But these are some of the definitions that I want you to keep in mind. So what is debt margin? Debt margin is your borrowing power, right? What you have left. And debt limit is the maximum that you can borrow, right? Yeah. I think in New Jersey, the debt limit is 3.5% for towns and 2% for counties. See, one of the good things, I think, at least that's the way I look at it, is from this course, you can take some things away if you ever decide to purchase things or look at what's around, because these are very important factors. You know, people look at homes and they say, wow, this home's really cheap here. Well, there's a reason why. And now you know the factors that go into it. Tax rates, schools, you know, other quality of life issues that we understand. These are, so buying a home isn't just looking at the purchase price, it's looking at all these factors, looking at trends. And fortunately, all of this information is available on the web for you to really get to. Okay. So these are some of the debt measures. These are like ratios, debt per capita. Tell me, a high debt per capita, is it good or bad as a taxpayer? Bad. Ratio of debt to estimated true value of taxable, a high ratio is good or bad? It's bad too, because you've got more debt than, compared to your taxable property. So these are some of the measures that we use, and we'll really study this in chapter 10. Actually, just to give you an illustration, on page there's a question at the end, and I want you to just see if you can figure this out, just to make sure that we look at this question 6.5. See if you can calculate the debt limit and debt margin. So what's the property value? 10 billion. What is the percentage? 1%. So what's the debt limit? Anyone volunteer for the debt limit number? So the property is 10 billion, 1% of 10,863,511. What is that equal to? $108 million. That's the debt limit. The second part is a little bit more challenging. What is the debt margin? Margin is what's left after you've issued the debt. Well, what do we have? We have approved but unissued tax-supported debt. It's not been issued yet, so that doesn't count. Revenue bonds. What does revenue mean? Revenue bonds, do towns issue revenue bonds, or do business-type activities issue revenue bonds? They're not in this calculation. Business-type activities are not in this calculation. General obligation serial bonds. Whenever you see the word general obligation, that's real debt. That's town debt. 43 million. That's included. Capital leases outstanding. Remember I told you, I think some time ago, towns use capital leases to skirt around debt limitation. So that's not counted either. So in this calculation of the 108 million, how much have you used? 43 million, which leaves you with a debt margin of 65 million. I've given you a similar problem as a homework exercise. See how we did this? We calculated the number, and then we looked at each item. If it was not issued, it's not issued yet. So it's still available. If it's revenue bonds, no, because that's business-type activities. Capital leases, no, because they do not factor into debt margin calculations. Okay. Did everybody get this? So the answer there would be 65,635,110 would be the debt margin. The debt limit was 108 million minus the 43 million. Yeah, yeah. Okay, everybody, okay. Debt service funds. The rest of this chapter deals with this topic, which is, this is the last of the governmental funds we'll look at. General fund, special revenue fund, permanent fund, capital projects fund, and now, which is the last one? Debt service fund. Got it? Okay. What are debt service funds used for? Exactly what it says. To service debt. So do you see now why it's called fund accounting? Looks like everything we create a fund for, right? We like to segregate things. And why governments do that is to allow better control on how monies are spent, rather than mixing everything up, okay? So basically a debt service fund, so I go out to borrow some money. And let's say the town wants to borrow $10 million. It's going to pay off in 10 equal installments, $1 million every year, because they bought an expensive piece of equipment which will last 10 years. So we'll make things easy. When I go out to sell these bonds, the people buying the bonds say, okay, we'll give you the 10 million, but this is what we want you to do. Every year at the start of the year, before you do anything else, deposit the $1 million that's due at the end of the year plus interest into your debt service fund. We don't want to wait till the end of the year when the bill comes due. Make that deposit right at the very start. And you say, all right, it's required by something called a bond resolution or a bond indenture. That's the document that we sometimes refer to. So where does the debt service fund get its money? From the general fund? Where does the general fund get its money from? Taxpayers? So the first year, what am I doing? I'm depositing in the debt service fund $1 million plus interest on $10 million. Let's say it's 5%. So it's $500,000 that I now deposit, right?
So it's the net payment
Plus the interest. And we need to keep it separate, as you'll see. And then when it comes due, what do? We pay it off. Next year, what happens? It restarts again. That's all. That's it. That's debt service fund. When the bonds are paid, what do you do with the debt service fund? Closed. Do you carry the debt in debt service fund? No. Debt is never carried in debt service fund. Only resources used to pay principal and interest. So the resources, that's where they come from, taxes, special assessments. Basically what GASB says is, again, only for general long-term liabilities, it says if you have 10 different debt issues, don't set up 10 different debt service funds. Maybe use one, or depending on what it is. You don't have to necessarily set up one for every single debt service issue. Every single debt issue. Now, there are two types of bonds. One is the very simple bond. Notice I use a very simple bond. And the other one's slightly more complicated. Serial bonds and term bonds. Fortunately, most governments use serial bonds because their CFOs are scared of using the term bonds. And I'll explain to you why, okay? Serial bonds, what happens with serial bonds? You make equal payments every year, right? There are different varieties of serial bond. There is a serial bond where the payment is deferred, the first payment, to a later period. A little trick by the CFO to avoid making the first payment. They defer it to a later time. But mostly they work by you amortizing it equally over the life of the bond. So the first year, you borrow $1 million. It's over 10 years. You pay what? $100,000. And interest is at 5%, $100,000 of principal and $50,000 of interest. What's the next year? $100,000 of principal and 5% of $900,000, because now you only have $900,000. $45,000 of interest. Do you see how it goes? So what happens? Your interest keeps on declining, right? That's your serial bond. And that's it. There's nothing more to it than that. Now we come to the more complicated variety, which is the term bond. Term bond works a little differently. Basically what they say is that what we're going to do is we will give you the interest every year, but not the principal. And you say, wait a minute, we want our principal. So you'll get the principal at the end of the 10 years. And you'll get it all, which is what? At the end of year 10, you'll get what? $1 million with the last interest payment. Got it? So what do? Does the town just say, oh, let's have fun for 9 years, and the 10th year we'll try to figure out where we get the 1 million from? No, what they do is each year they put into something called a sinking fund. Has anybody heard of this term? A sinking fund is a fund where monies are deposited so that at the end of a period they will be available for you to use. Okay? You don't take it out. So this is what happens. So we've got a really smart CFO. He says, you know what? I've got a great idea. This is what I'm going to do. Instead of making a payment of $100,000 every year, I'm going to put in $95,000. And you say, but we need $100,000. He says, no. I'll put the $95,000 and I'm going to make money on that $95,000. I'm going to make lots of it. So it's like putting $100,000, that's what I have. So basically what they do is, you know this concept of future value, right? Learned that present value, future value, okay. So basically what you're trying to do is you're trying to come up with a rate of return where you make a series of equal payments into a sinking fund. So at the end, those payments with interest will equal $1 million. That's called future value of an annuity. If there's anything, you always make sure, like the back of your hand, there are 4 things you should never, as accountants, never forget to use. Concept of present value and present value of an annuity, future value and future value of annuity. So if I said to you, okay, at the age of 67, I'd like to have a nest egg of $5 million. My rate of return is 7%. I have another 40 years to go. What should be my deposit each year? You should be able to calculate that very quickly by using the future value of an annuity, except in this case you'd be dividing by the factor. And same thing with the present value. You just won the lottery. The state comes in and says, you know, every year we'll give you $500,000. Or you can take this number today. Well, what would you do? You take those future payments and calculate the present value of an annuity based on the interest rate that you feel comfortable with. And then you can figure out, okay, you know, these guys, if I take the money now, that's a whole lot more than taking the money later. Now, obviously, I haven't taken into account tax considerations, but this is how we use, and unfortunately, a lot of accountants don't understand these concepts. You really need to know this like the back of your hand. This concept of using present and future value to be able to do this, because that's what it's really finance is based on. So here we have the serial bonds. Advantages of serial bonds: they're self-amortizing, no sinking fund needed. Okay. Let me see. These are the term bonds. I think I explained to you this. They require a sinking fund and somebody who really knows what they're doing. Because if you deposit a certain amount and you are assuming a rate of return of 10% and you get only 5%, are you going to have your $1 million at the end? No. You're going to be in trouble. And that's why, fortunately, many public entities don't use this because it's scary. Couple of items on understanding accounting principles and procedures for debt using modified accrual basis. Budgetary accounting, you don't have to use budget. You know what the principal and interest is going to be each year, okay? Term bonds, sinking funds reported at fair value. You have to show that because now you're investing. And by the way, in investments, as we'll see in Chapter 9, government securities are required to be reported at fair value at the end. There are balance sheets. You'll see one of the exercises, for instance, in the CAFR exercise. You will not find a major debt service fund. They're all non-major. Very hard to find that. Now, let me explain to you okay, this was, I skipped over this, but this is one of the most, the first slide, the first bullet is very important here. Principal and interest. Let's assume you have a bond which pays interest on October 1 and April 1. Your year end is December 31st. What would you do in a business enterprise on December 31st? You'd calculate interest accrual, right? For 3 months, from October 1 through December 31st. Under modified accrual basis, no. Okay, now we've got a really smart CFO. Comes out and says, issues bonds on December 1 of the year. First interest payment is due 6 months later, and then again 6 months later is principal and interest. So both the principal and interest are due a year from that December. He uses a deferred serial bond where the principal payment doesn't kick in till January 1. Basically what happens now is you have totally avoided paying the principal during the first year. Or even let's take an easier example with the interest. So take this example again. You issue a bond on April 1. When's the next interest payment? October 1, right? So you make the interest payment. When's the next interest payment? April 1, where you pay the interest and the principal. Guess what? That first year, only one interest payment. Not 9 months of interest, but only 6 months. Because what modified accrual basis is, says when interest and principal are generally recognized in the period in which they are legally due. Since it's not legally due on December 31st, happens all the time. Play around with the interest payment date to escape the first year's full interest payment. Do people understand that? Do you see how let's take a look at an example. Assume bonds are issued on January 1 and pay interest on January 1 and July 1 in the amount of 100,000. The fiscal year ends December 31st. What amount of expenditures? Whenever you see the word expenditures, what does that mean? Modified accrual basis. In your mind, little lights of cash should go up, right? Okay. So what amount of expenditures would be recognized in fiscal year 2014? Not expense, expenditure. Only the first one, which is what? 100. We only missed by 1 day, right? Because the next one would be when? Would be January 1st. We missed it by 1 day. You mean for 1 day we don't have to accrue? Yes. Now, let me ask you a question. Looking at this, how would you do it on the accrual basis? If you had to calculate this for the statement of activity, the interest expense.
December 31st, you have interest accrual, interest payable.
That's right. You'd have interest accrual for, yep, you'd have that entire year accrued in the statement of activities. And remember, interest shows up as a separate line, right? Interest on long-term debt. See the difference between statement of net position on accrual basis and statement of revenue and expenditures on the modified accrual basis. Okay, everybody clear? By the way, just make a note to look at this example further on page 220. Okay, that just shows you a little bit more. So I want you to really get this down. Okay, on page 220. The term is when it's legally due. And basically, this is what happens when you know, if you're spending money as interest or principal expenditure, you need to get it from somewhere. And you get it from the general fund, from the taxes, and that account is called estimated revenues. You set that up, okay? Estimated other financing sources. And these are, I'll tell you, there are quite a bit. There's quite a bit of journal entries here. So this is what they had. They issued 100,000 of 6% bonds. This is the detail on June 1 and December 1st. First year, they're using a budget here, estimated. Whenever you see the word estimated and appropriation, those are what called budgetary accounts. Do you record budgetary accounts? No. In governmental activities, none. Why is it 11? It's 6,000 of interest payment and 5,000 of principal. Yeah. Now, this goes on through a whole cycle, and I'm afraid if I go through this whole thing, you're going to fall asleep, because there are quite a few. There are like at least 20 slides here. But if you can bear with me, just try to follow some of these, okay? Debt service fund receives cash from the general fund. Debt service fund receives cash from the general fund. But you see, why does it show up in the governmental activities? It's all taking place within the family. Governmental activities are government-wide. You know where it says governmental activities? Just in your head, think about government-wide, okay? If you have problems with that term. That's why there is stuff going on between interfund within the governmental side, so we don't record it in governmental activities. Interest payment is made. Notice how we showed not just expenditure, we label it as bond interest. And we show, instead of expenditure, we show what? Expense. They get another $8,000 from the general fund. This is how they spend the next one. Classic entry. Credit cash, show each of the components separately. Same thing here, a little bit different. Now we call it expense, and we are amortizing this because we are debiting a payable, reducing the serial bonds. Adjusting entry at the end of the year. Notice the accrual of interest on the full accrual basis. 1 month of accrual of interest. Interest is not accrued in the debt service fund since it's not due on December 31st. Important. Anyone not understand that? And this is the closing entry that occurs. That's the complete cycle of journal entries. And then you can just keep on going year after year. But it's the same entry. Just the amounts are different. And what happens is when you close the budgetary accounts and you close these accounts and you're left with, at the end of the year, zero. There's nothing left in the debt service fund. Okay. Term bond, we'll go through this. By the way, on the term bond, I'm not going to hold you responsible for the calculation on term bonds. So you can write that down. If I forget, remind me. Okay? But I'm not going to hold you responsible for the calculations for term bonds. Because they do use, you do need to be very comfortable with doing calculations, financial calculations. Not that I don't expect you to, but I think you probably will learn this better in a class, in a finance class than in an accounting class. This is how, just to give you an example. See how these guys came up with this example? They put in each year 17,389. These are the earnings that they expect to make, and at the end they'll have 100,000. But what are the chances of their making exactly 7% each year? Not very good, right? It could be more, it could be less, but it all ends up where? At the end. So that's why people don't like to do this. But see how we calculate the present value just by taking the factor and dividing it to 100,000. Just gives that to us immediately. And then, as I said, I won't hold you on this or the journal entries required because they are different. They change from year to year, the amounts. This is the first year it comes in and is spent. Remember, interest is paid regardless whether it's term or serial bond. You have to pay interest. It's just the principal that you don't have to worry about with term bonds. And these amounts, as you can see, are investments, and goes on. Let me see where we end with this. Does this just go on for a while here? We'll go to slide 42. Okay, special assessment debt. Just a quick note. So there's debt which is paid by general property taxpayers, and then there's debt which is paid by those people who benefit for improvements taken from that. That's called what? Special assessment debt. Now within that, there are two flavors. There's one where the government guarantees that it will pay the debt if the property owner doesn't. And there's another one where it tells the bondholders, hey, you're on your own. If the property owners don't pay, it's your problem. What do you think the chances are of selling that kind of debt? Not very good. So in most cases, governments do what? Sell special assessment debt where they back it up. And if they back it up, it's shown here. If they don't back it up, it's shown in, as we'll talk about later, in the agency fund, in the fiduciary funds. Okay? But so two types of debt: general debt, geo debt, from property tax, general property tax, and then special assessment. Special assessment, two flavors. That's which is guaranteed by government, and that which is not. Okay? If it's guaranteed by government, it looks exactly like the geo debt which we just saw. Okay, in this case, they did $1 million worth, and where are they getting their money from? From the property owners. So when they set up a receivable, Here, $1 million worth of special assessment has been levied, payable in 10 equal assessments. I want you to just think about this journal entry for a minute. See if you get this journal entry. How much money do they expect from the property owners over 10 years? $1 million, right? How much of it is current? 100. Everybody see this? 100 in revenues and 900 in deferred. So what's the current portion that's receivable? 100. And what's the deferred? 900. Okay. All assessments were presented along with 8% of interest on the previous unpaid balance. Okay, 8% of $1 million is 80,000. That comes in as revenue, and that's all we do here. Next year, what happens? Actually, we need to pay. We got the money, now we need to pay the principal and interest. So you need to record with debt service fund where the money is coming from and how is it going. If you get those two transactions, you got it. There's nothing more to it then. Usually get it from the general fund, or in this case, from the special assessment property owners. Notice what happens the second year. After you close these accounts, oops, they don't show you the second year. What are you going to do? You're going to reduce the deferred revenue by 100,000 by debiting it, right? And create another current assessment. So this entry keeps on repeating itself.
So it wouldn't be 800,000?
Yes, now it's 800,000 left in deferred revenue because it was 900 before, right? So now we're debiting it, right? So now it's what? 800,000 which is left. So this entry keeps on repeating every year, this entry that you see. Capital lease obligations. I think we talked a little bit about this. Why is it shown here? When we talked about it already, it's shown here because some entities show capital leases in debt service fund. They do. Some do, some don't, but some do. And that's why you see the example here. This is the same entry that we saw before. Okay. Now, let's take a look at, I want you to just think about this transaction for a moment. First, the unpaid lease obligation at the beginning of the year was $57,590, and a $10,000 lease payment is made at the end of each year. If the lease has an interest rate of 10%, first the math. 10% of 57,590 is what? 5,759. That's the interest. How much are you paying each year? 10,000. So what's the balance? Principal. See how we backed out? We did what? The interest calculation first. We knew what the amount was. This is like your home payments, your mortgage payments. Okay? Your car payments. So this number here is backed out from taking this number minus this to come up with this. It's not good enough to just show $10,000 expenditure lease payment. You need to break it down into interest and principal. Key calculation you should be aware of. Always take the ending lease balance, calculate the interest. Once you got the interest, subtract it from the total lease payment, and you've got it. Next topic, debt refunding transaction. This is not a terribly important area, but it's an interesting area because, you know, who's one of the biggest debt refunder in the world? United States government, U.S. Treasury. They refund bonds all the time. Treasury bills every week, Treasury notes, long-term Treasury bonds. They don't have the money to pay it, so what do? They refinance it, right? As soon as the money comes in, where they need to, I don't mean to make it so simplistic, but when the payments come due, what do they have to do? They have to find money somewhere, right? So what do? They go out and borrow, and they pay off the old debt, and it just keeps on going. The cycle keeps on going, right? Now, but that's not what I'm talking about here. What I'm talking about here is maybe there is a genuine reason to do refunding or refinancing, for instance. What might be a genuine reason? Why, if you're the CFO for a government organ, why would you want to? Okay, so your debt carries an interest rate of 6%. And last time you looked at the bond buyer magazine or the paper, it says interest rate, you can borrow money at 3%. What would you do? You want to pay off that, it's like your home mortgage, right? You want to pay off that expensive debt and do what? Refinancing. That's one of the reasons for taking advantage of lower interest rate. Another reason, you're running into a little problem. Don't have enough money to pay the principal in the years ahead. So as a CFO, what do? You say, all right, I got a great idea. How about if I make the principal payments smaller in the future? How do you do that? Refinance it into a longer term obligation. Is that a good thing? Not too good, but a lot of people do that. Okay? So an obligation which was to be paid over 10 years, had 10 years left, you make it into 20. And what do? You cut your principal payment in half. That's another reason to do refunding transaction. But basically, and then there's another reason, which is more of a technical reason. Sometimes when you borrow money, they impose really harsh conditions, like you can't do this, you can't do that. You need to deposit this much money. You need to deposit 3 years worth of debt service up front at any one time. And you say, you know what, these guys are bad news. I think what we're going to do is get rid of this bond. So you do it for technical reasons, because the covenants, bond covenants, are very harsh, are not really something that you want to live with. So those are, when you think about it, those are the 3 reasons why we do this. And as you can see, the transaction's pretty straightforward. You borrow money, so what happens? You get cash, shows up as other financing sources. Just one thing about debt service fund. If you make interest on funds that are sitting in debt service fund, if they're sitting there and they're earning little interest, that's shown as revenue. If money is coming from other places, that shows as other financing source. They're both the same thing, but one is called other financing source, where money is coming in as a transfer in, and where you're making little interest on money which is sitting for 6 months, 9 months, that would be revenue. And as you can see, they pay off one bond, and this is the old bond that they just paid off. They got money after they got the money. Advanced refunding, again, very technical transaction, and I won't go too much into it except to tell you that in many cases, actually I was involved in one of these, a very big transaction here. It was like $96 million where we had to do debt defeasance. And basically what this is if you have bonds which are coming due in the future, you have $1 million outstanding, and you just sign an agreement where you cannot pay off the bond, you cannot pay them off early, but what you can do is deposit enough money to pay them when they come due. That's called bond defeasance. And there's legal defeasance and in-substance defeasance, but basically what it is you have satisfied, it's like almost like paying the bonds off, because you have the resources, you put them aside in the debt service fund. When they come due, they'll be paid. So that's advanced refunding. All right, so that's pretty much it for this. Couple of things here. I will let you go. So for this week, the CAFR discussion is going to be on chapter 5 and 6. Read the instructions carefully. The other thing is I would really appreciate it. I saw, I think in one case, someone didn't respond by the Friday midnight deadline. Don't do that, okay? Please do respond the first